Hello and welcome to another episode of the Real Estate Investing Club, the place investors go to gain actionable advice, learn about current market trends, and hear war stories from other professional investors out there in the field today. Before we get started, I have two quick housekeeping items to cover. First, if you like the episode, we would very much appreciate a like, subscribe, and share. It is the best way to support the show and keep it running. Second, if you are a new investor looking to get started in real estate or an experienced investor looking to take your investing to the next level, we created an ebook for you that will cover how to find deals that are actually deals, how to finance those deals with little to no money down, and how to exit those deals for maximum value. On top of that, I throw in an insane amount of free bonuses that you'll have access to once you buy the ebook. All we charge is our admin cost to keep the show running. So, if you're serious about real estate investing and want to create both active and passive income as an investor, head on over to the website at therealestateinvestingclub.com and click on the button that says Get the ebook to grab yourself a copy today. So with that said, let's dive right in. Today we have a very special guest with us, ready to drop some investor knowledge on you. So buckle up, grab your pen and paper, and enjoy the ride. All right. Welcome back to another episode of the Real Estate Investing Club. Today we have Toby Mathis with us from Anderson Advisors. They are legal, business, and tax advisors, which is always the thing that gets a lot of real estate investors out there tripped up. So I am super excited to have Toby on here to share a bit of his wisdom. Toby, thanks very much for hopping on the show.
Thanks for having me, Gabe. Excited.
Absolutely. I told you before we got on here, we like to start with stories. We like to hear how people got to where they are today. I know you got a good one. You got a thriving legal business, tax advisory business, as well as a huge portfolio. So you've seen the ups and downs. Why don't you take us back to the beginning? How'd you get started in real estate?
Actually, good question. Kind of a roundabout story. I'm a tax attorney by trade, but I became an attorney because I didn't like lawyers. I had a mentor who was really important to me. And if you don't have a good mentor, make sure you get one. But he was constantly stressing the idea of having assets that pay you while you're sleeping. And voila, real estate fits that bill. Created my practice with a partner back in the late 90s, and just started accumulating properties. I think I told you, we're several hundred properties now. But so we have a legal and tax business that allows us to do our addiction of buying real estate. And we have about 500 employees at the firm. Love doing that. Love sharing information. Love showing people how to reduce their tax bill and how to protect their assets. But what we all love doing is buying properties and goofing around with them.
I can totally relate to that one. And I actually, I didn't tell you before we got on here, but I actually started going to law school. I was going to go to Vanderbilt. I was applied and I was accepted, and then I went down that path. A friend came to me and he was working as a management consultant. And I was like, you know what, screw more school. I'm going to go just start working. But I kind of wish I did go through law school, because you guys have a leg up, especially when it comes to real estate. You understand both the legal side of things and the tax side of things, which is kind of a quagmire from someone coming from the outside. So you got into real estate, you got into tax advising, and then you got into real estate. What was the transition there? What was the first type of asset that you bought?
Boy, really good question. I think I started buying. I mean, you always start with buying your own house, right? You start looking around, and I was in Seattle again, late 90s, and I didn't have a pot to piss in when I started, and so I rented a place, a little box up on Queen Anne, if you know the area.
Nice.
And
what year was this?
This was in 1997. There we go.
Okay. So kind of the grunge scene was still going on.
It was still going on, and I may have played a little bit in some of those clubs.
Oh, right. I like that.
I was a bass player, loved it. But it was really a great area, cool area, and it was funny because it was my mentor, a guy named Jerry, and his kid, and I went to law school. Jerry went to school too, law school, because we were all ticked off at the lawyers because they would screw everything up. Every time we would have a big deal, they would try to talk us out of it. And,
Don't get me started on negotiating with lawyers. It's the worst. No offense.
It's like Tinder, and here's a flame, and then they'll kerosene on it, and they'll be like, why is there, like, then there's fire, you need me to put out the fire, and it's like, you caused the flipping fire, you did this, and now I'm going to pay you to fix it. Yeah, no, lawyers are wonderful. They think in a particular way, but we all went there so we didn't need them. And what's funny is Jerry started law school and he got kicked out within 6 months because he would argue with the professors. It was
he's a good lawyer.
They don't like being, hey, there's rules, right? If you violate their rules, you're out.
That's funny.
But anyway, so I got into that. I just worked with small businesses, and I'll tell you what, you can't be around a small business owner that isn't looking at real estate at some point, whether it's for their own location. And I ran across two really important people. One guy was you won't use their last names, but Tim and Boyd. Boyd is still active in real estate in Burien area, and he had hundreds of properties when I met him, and I met him probably in 1989. And he kept talking about cash flow real estate, and my skull was still too thick. I think as you get older, your skull gets thinner.
Things start to like permeate the
took
actual
about 10 years for it to really. Oh yeah, that's what he was talking about.
That makes sense.
Yeah, but he was really important. And then also Tim, and Tim was an interesting character. I would meet him. I was a guardian of a gal. I would do guardianship work and things like that. And I still think it's important to give back. But so I was a court-appointed guardian for this indigent old lady. And we were talking, and he started telling me a story about how he just train wrecked his life. He had a couple of the most successful restaurants in Seattle. And he said Coke and women took it away, right? He just,
it's the worst.
He would just get wasted. And he was like, so he lost his restaurant, but he'd always taken the money and bought real estate. He goes, I couldn't screw that up. He goes, that's the only thing that kept me going, is that I had this real estate that would just keep paying me. So even if I would sabotage my life, I still had money coming in no matter what. And he goes, I would advise you to do that too, young man, and stuff like that. It was always funny when you hear these guys, and they were pretty transparent. He's like, I did everything I could to put myself into bankruptcy and to try to and I just couldn't do it because I have these properties and they're just spitting out cash. And no matter what I would do, I couldn't destroy it. And I was like, oh, okay.
Yeah, that sounds like a good plan.
Yeah.
That's funny. So you met this character. It sounds like, everybody needs that ornery old man who has all the wisdom to share. You need somebody like that in your life. Sounds like he came into yours. Once you started buying these properties, I'm sure you ran into the tax implications of owning real estate. And that's one thing that a lot of people, they don't quite understand. Even myself, like we just did a cost seg study on one of our properties, and I don't get it. I get that we're getting benefits, but I don't get the entire package of what goes into taxes and real estate. So can you kind of give us a little bit of insight into, what are the advantages of owning real estate, and why should someone, who owns a restaurant and has this excess profit, they want to put it into something? Why should they choose to put it into real estate versus the stock market?
Yeah, well, you know what? I would say do both. I'd always say do both. Like, you want to have a little bit of diversity, but when you invest in the stock market, treat it like real estate. If I'm going to buy real estate, the whole idea is to buy cash flow real estate. Don't just buy real estate and hope that it goes up. The appreciation is not your game. You should look at everything as though your holding period is forever. Yep. I'm going to hold this for 300 years. Think about your kids, right? That's where you want this money to be generating. It's 200 to 300 years down the road, and it changes what you look at. And so it's kind of like going around the Monopoly board. You're looking for things that are going to pay you rents. Same thing in the stock market. You wouldn't buy a house and leave it vacant and hope that it goes up and then sell it 10 years later, right? That doesn't make a lot of sense. You'd look at it and say, well, no, I need to put it into action. But we do that in the stock market all the time. They'll be like, oh, let's buy some Amazon. And they don't pay a dividend.
In 30 years, we'll see what happens.
Yeah. And it's like, you're just dumb at that point. Not that my brother works for Amazon, so I shouldn't say that's dumb. Amazon's a great company. but you want to create wealth off of it. And so the two ways you make money off of the stock market is you get dividend producing companies. There's companies that have been paying dividends for 50 years or more, and you rent it out. In the way you rent it out is something called a covered call. I'll leave it at that. So you do that with your stock, but on your rentals, you want to make sure you're cash flow positive, because you never know when you're going to be in a hardship. And all that means is, if we go back to my buddy Tim, and he had his restaurants, everything else, he had cash flow positive real estate that it would net out money every month and put it into his bank account. If I own real estate and I'm having to pay for that real estate every month, I'm having to shortfalls and I'm having to maintain it. That's not an asset. That's a liability, and that's going to kill you. And especially in this type of market where we're like, everybody says real estate bubble or this, that, or the other. What I know is people aren't going to be buying properties like they did, because money's not as cheap.
Yeah.
So
it's like 6.25 now. It just keeps going up. It's crazy.
It was 6.7% yesterday.
Jesus.
So yeah. So the cost of buying these things has gone up exponentially. Like, it's literally doubled the price that you would pay on a mortgage. So affordability becomes an issue. So you got to wait for these things to correct. And then while you're waiting, you need to get paid. So, and that's why I always use the rule is like, would I buy this property and keep it forever? And would I keep it in my arsenal? And quite often it's just, I don't care what the property looks like. I just care what its numbers are. And you don't buy on comps, you buy on cap. You buy on what it produces. And I can tell you what any property is worth just by what it's generating. And I don't need to worry about the neighborhood and this, that, and the other. You stay out of war zones, and you try to be in good areas that have low unemployment and great industries, and they have a good moat around them so that they can withstand recessions, which historical data will give you. But once you're there, you're just looking for things that are, hey, you know what? I just want, like, once I know an area, once I know a community, I'm just going to buy there. So, and there's so many in this country that are still great. And I personally look at this saying, this is a personal thing. When you're a landlord, you have a lot more autonomy than a lot of these funds do. Like, they're coming in and buying houses. And by the way, like, we sell a ton of houses to the funds that we just wholesale them off because they'll buy at 4 cap. Yeah, whereas the individual investor wants 6, 7, 8 cap. So you're like, here's the crap, it goes over there. And they're just like machines. They're robots. They're not negotiating with tenants the same way you can. They're not doing things like, hey, you know what? I really want to help single moms out. Or, hey, I want to help out our veterans. Like, I have a veterans park. We call it Warrior Park, where you're like, you know what? I'm just going to focus on one area and help out this particular group. You could do that. You could do whatever you want because it's your property. You could be pretty darn autonomous.
And so long as you're focusing on the cash flow, you really have that flexibility in strategy.
Yep. And I think it really comes down to people like us. We're probably underbuilt by 3 million units. The Harvard Joint Housing Report comes out and it's over 3 million units, which means that we have lack of affordable housing, period. We have more people looking for housing than housing exists. So you have this massive demand, but they don't want $2 million houses. What they need is a house that they can live in.
Workforce housing, $200,000, $300,000.
Yeah. And to answer your question, because I just completely ignored it and was going on.
It's all good.
But the tax stuff, once you buy a house, you get to write off the improvement. So if there's land and there's a box on the land, somebody's going to live in that box. You can deduct the value of that box over time. The problem is that the lazy way to do it is to say it's 27.5-year property if it's residential, it's 39-year if it's non-residential. So people go in and they say, oh, it's 27.5 years. And accountants do this, 99% of them. That's actually an impermissible method. So you're not supposed to do that. You're actually supposed to go into the house and say, oh, the driveway's 15-year property, the carpet's 5-year property, those cabinets are 7-year property. And you're supposed to break the house out into its components, which you just mentioned, cost segregation. That's what they're doing. They're saying, here's the value of this asset. Here's the value of this asset. Like, they literally go out and count the tree.
Each different type of asset depreciates on a different schedule.
Yeah. So you take a property that you would be depreciating over, let's say 27.5 years. Let's say that you had a property, you bought it for $350,000. Let's say duplex, fourplex, whatever it is. And the land we have to discard. So we don't get to write off the land. So let's say the land is $75,000. So now we have.
So sorry, I'm stopping you there. So we don't get any tax benefits from buying land?
No, unless you're
Interesting.
improving
I
that
actually
land.
did
Land
not
just
know
sits
that.
there because land doesn't lose value.
Right.
If I buy a computer, I'm using it up. It's going to have zero value in the IRS says in 5 years. So they let you write it off over 5 years. Same thing with an automobile, airplanes, 7 years, driveways, 15 years, the fence is 15 years, things like, shrubbery and trees are 15 years. It's weird stuff like that.
Shrubbery and trees are 15 years.
That's what they
funny.
say.
Yeah.
But what we have is under the Tax Cut and Jobs Act, we have this thing called 168K that's bonus depreciation, which is 100% this year, which means anything that's 20 years or less, I can write off in the first year that I buy it, or the first year that I choose to elect to treat it as a separate personal property from the structure. So going back to you're doing a cost seg on a property. You could have owned that property for 3 or 4 years, 5 years, and you could do a cost seg right now and take all that accelerated depreciation right now. And it's usually about, on a typical single family, it's about 30% of the improvement value.
Which is not something to wag your finger at. That can, especially when you're looking at multiple properties, that adds up.
Right. And then the only issue is it's passive. So it offsets your other rents or passive income from businesses that you don't materially participate in, but it's sitting there for benefit. If you sell the property, it releases the if you have loss carry forward. Like, so if you did a cost seg and you had this big loss that you weren't able to use it all. Like, hey, I don't ever have to pay tax on the rents I receive. Right. That's not a bad thing. That's why people that are real estate investors don't pay tax, is because I have this huge loss. But hey, if I sell it, I really don't want to pay tax on the gain either. Okay, well, you get to release the loss when you sell it. So it could offset the gain if you didn't want to do a 1031 exchange, or, so if you're just going to dump a property, you release the loss and it becomes an ordinary loss. It can offset your any taxes that you had to. So That's why people love real estate, is literally we can kick the can down the road indefinitely. And then the punchline is that when you die, all of your basis steps up. So your heirs, let's say you bought a house at a 300,000, it goes up to 500,000. If I sold that property for $500,000 during my lifetime, I'd have at least $200,000 a gain I'd have to worry about, plus dividend recapture. If all I do is die, it steps up to 500, and now my heirs get to redepreciate it. But if they sold it, they'd pay zero tax. That's why real estate investing is such a great legacy tool. It's like,
wait, I'm gonna pause you again, because I actually didn't know what you just said. So if my children, or if I die and my children inherit my properties, they get to inherit those properties as if there was no taxes, applied to the property.
Exactly.
Or tax debt to the
property. Your basis steps up on capital assets, and this works for stock too, which is why all rich people have stocks in real estate. If you have a capital asset, it steps up on your death. If you're married and you're in a community property state, 100% of the value steps up on the death of the first spouse to die.
Huh.
If you're in a separate property state, half of it steps up. So like you're in Washington, right? So community property state. So let's say that you're married and you have all these assets, and something happens to you, Gabe, and your spouse is there, and they're freaked out, and they want to sell some things. They don't have to worry about the tax on it. There is none. So I depreciate the heck out of it during my life. I borrow against it and get cash out. And all I have to do to never pay tax is die.
That's all you got to do. It's so simple.
Yep.
But this is why we have tax experts, because the tax code, I swear to God, it is way too complicated for any regular person, even somebody who is in real estate like myself, to understand. It's just beyond me. So those are both things that I didn't know. I'm glad we were able to kind of tease that out. I took a peek at the clock. We are running down the time. Before we move on, though, I did have one question that I was actually going to ask my tax advisor, but since you're here, I'm just going to ask you. Does your loss carry over year to year? If I don't use all of the depreciation from my taxes last year, do I get to benefit from that to this year?
Yep, it carries forward indefinitely. And here's what it does. It sits there and looks for any other passive income. which it's not just real estate. It's any business that you do not materially participate in. So if you're a silent partner in a pizza parlor and it kicks out $50,000 of income, you're partnered up with Uncle Sal, right? And you have a pizza place and it kicks out 50 grand and you have $50,000 of depreciation expense, it'll offset. Or when I sell the property, if you have loss carry forward, it releases and becomes ordinary. In English, okay. I can write it all off at some point in the future.
Perfect. I love it. All right. Well, that puts me at ease. I appreciate that. I am going to move us on into the quick question round because we have gone through our time. So are you ready?
Always.
Let's rock and roll. It starts with books or any form of education. I'm a big bookie, so give me 2 recommendations, one for general life wisdom and one for real estate or business specific.
All right, I'm going to be horrible. So I've written a bunch of books, right? So Infinity Investing was a gold medal winner and a Amazon bestseller. Still floating around out there. I think I published it last year, and it's a good tool. It's just stories from all the people that I worked with, and I steal I have a whole bunch of high income clients, and I just steal all their good ideas. But you don't need to just go to my stuff. Rich Dad, Poor Dad. If you just want a good core book, I did Robert Kiyosaki's. My firm taught the tax and asset protection behind the Rich Dad, Poor Dad seminar series for close to 17 years.
Oh, wow.
I think it might be longer now, but really interesting stuff. Robert's an awesome guy and easy to understand. It's a life-changing book. I think it was published in 1998, but it had a big impact on a lot of people. If you haven't read it, go read Rich Dad, Poor Dad.
I swear to God, 3 out of 4 investors that come on this show, we've had we're on episode like 280 something. 75% of them say Rich Dad, Poor Dad. It's because it's, it doesn't tell you what to do, but it tells you why you should do it. It's a really good book if you guys are just starting out. Infinity Investing, though, sounds, especially if you're taking, it's just a, compilation of other great investors' ideas. That sounds like a great book to have on your shelf. So if they wanted that, they should go to Amazon.
Yep. Just Amazon, Infinity Investing. And it's a free community. If somebody wants to join it online too, it's again, I'm a tax guy. So pretend that I was a barber. I want everybody's hair to grow really fast. So in my world, I need people to make a lot of money so that they can have tax issues.
There you go. Makes complete sense. All right, moving on. This next question is for your younger self. So if you could go back to the Toby who was, let's say he was just sitting down to do his LSATs way back in the day, go to him, look him in the eye, give him one piece of advice moving forward.
Invest earlier. Invest right away.
Yep. Solid advice echoed across many episodes. Everybody wished they started earlier, including myself. So if you guys are listening and you haven't yet bought a property, just pull the trigger, go out there, make sure it cash flows like Toby says, make sure that there is money coming to you every month, but just pull that trigger and get started. And that leads us to the next question. This one is location based. The United States, it's a very large country, many square miles out there. So what is one metro that you are most excited about investing in today?
Winston-Salem. We've been there for about 5 years. We had 42% increases in rents last year.
Wow. Jesus.
Not stopping anytime soon. The houses are affordable, still a great market. Love investing there. Everything.
And that's Oregon?
That's North Carolina.
North Carolina. Okay.
It's in the Triad area. So High Point, that area. Just a really neat area. It was, I think it was Philip Morris. All these houses were built by the tobacco companies, right? They're all pretty much the same. So we keep buying these little houses. They're 3-bedroom, 2-bath, just churn them out. Boom, boom, boom. You know exactly what you get. The floor plan. We already know most of them. And great working class rental market. We can do affordable rents. So we pick up those houses for 120,000 all day long.
Wow.
Years ago, they were 50,000, right? They were just really cheap. They're going up a little bit because there's a little more demand, but we still love the area. Charlotte was the same thing, but Charlotte's all ramped out. Everything we bought there is tripled, quadrupled in value. So you're like, okay, we keep moving. And all along the way between Charlotte and Winston-Salem, I'd say that those are great areas, just on cheat sheet. Kansas City, Missouri is a great area too. You can't really go wrong in Ohio, But if there was one area that I focus on, it's Winston-Salem.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast. Yep. I've, North Carolina, South Carolina, Georgia, those, Florida too. I mean, those, not right now, but Florida, North Carolina, Georgia, South Carolina, those states are really, they're really going through the roof. It's crazy. Double-digit growth across many of those metros out there. And I didn't ask you before. We should have, it's going to be part of our quick question round because this is my podcast, damn it. Mm-hmm. You focus on single family. How do you guys manage those? Do you have in-house management or do you do third party?
We do third party on a lot of it. So like we're in Oklahoma City, Houston, the Winston-Salem area, Charlotte area, Indianapolis. Of course, everybody and their mother was going to Indy for the longest time. Still a great market. Trying to think of where else. Las Vegas. We have some Washington. We did have Georgia. And in most of those markets, we use a outside third-party management. In one of the markets in Winston-Salem, we actually own a piece of the property management company just because we have hundreds of properties. At some point, you're just like, hey, you know what? We want to at least be part of it. But property management stuff. The good property manager, you wrap your hands around and hug them and send them something for Christmas because they're hard to find. And it's not a profitable business. Really, the profit, it comes in doing rehabs and in the maintenance, and when they buy and sell properties, really the property management's not the most profitable thing in the world, and it's a lot of hard work. So when you get a good one, you treat them really, really well. Don't rag them and don't try to drag their fees down. They're usually on paper thin margins as it is.
Yeah, I will second that. Thank you, all the property managers out there. We really appreciate you. You guys are, you're better than gold. If you find a good one. Yep.
Gabe, I'll tell you this one thing. I was talking to our property manager, and they're like, oh, there's a body in unit such and such. We have an apartment complex. And they're like, oh, shoot, somebody must have OD'd. They're like on the phone with me, and they're like, hey, could you have so-and-so go over there, make sure that we, that we call 911 and we get somebody over there. It's like the stuff they deal with.
Totally
like,
normal. Yeah.
There's a body over there. It looks, oh yeah. Like,
yeah. It's stuff that if you had to deal with on a day to day, it just baffles me. But again, to echo your sentiment, if you find a good one, hold on to them, treat them like they are royalty because they are worth it. I'm going to move us on to the next question. And this one, you already kind of touched on it earlier. Mentors, we all stand on the shoulders of giants. None of us are here on our own. We're all learning from each other. So what is one mentor in your life who has contributed the most to your career growth, and how did they help you out?
Well, I'd go back to my buddy's dad, Jerry. And Jerry was just one of those, he was a liquidator. So through high school, I'd go do conferences. We'd travel around the world buying crap. That was fun. Excess merchandise. Back then you you didn't have the internet, so you'd have to Rolodex it, and you'd have to have people that you could sell stuff to. But he was just really opinionated about having freedom. And saying, hey, you want to work for yourself. It's not for everybody, but there's nothing quite like it when you get to decide what you want to do with your day. And so that I've never worked for another firm, never tried to go do the whole, hey, let me do the 80 hours for somebody else thing. I always just hung my shingle out and I ate it. You eat a little bit of poo for the first 3 years.
Oh yeah, for sure.
But it's worth it. That's why I always say to people is, and then you love those days. Like if I ever think back, I'm like, it was really interesting. We were talking about this before the show. Like I lived in the hilltop of Tacoma where I was next to a crack house, and I still find it amusing, like that some of the crap that went on in that town was just insane. But it's like I didn't have any money, and this is where I could afford to live. And those days don't have to be a bad thing. You just get through them, and then you always can look back and go, man, that was pretty hilarious.
I fucking made it. I made it through that.
I made it through the gauntlet. I win. But then you're also not afraid. One of the things that a lot of investors can't get over is fear. And if you just get rid of the fear, hey, worst case scenario, it's not so bad. Like we're living in a first world country that it's never going to be too bad for you, right? And especially if you're investing, chances are you won't be able to screw yourself up too bad if you buy cash flow. If you swing for the fences and you start doing flips and you're buying stuff that you hope appreciates, you might be disappointed and you might have some pain because of that. But if you're just doing raw, cash flow, people always need a place to live.
Yep, absolutely. Buy for cash flow. And we'll just send a shout out to Jerry. Thank you very much for helping Toby get to where he is today. And that leads us to the next question. This one is your Superman strength. We are all gifted with something that we uniquely can provide this world. You are no exception. So what is your Superman strength? What do you give to the world?
Teaching. Yeah, I love to explain some complicated subjects, and I try to make it into bite-sized pieces. We call it K through 12ing it. And so I'm a big proponent on advocating for people to do things like give and invest. And those things go like that. They go nicely together. So if I have any strength at all, it's the ability to educate folks on what are some complicated subjects and make them fairly understandable.
Perfect. I love it. All right, we are rounding it down. Second to last question. This one is about tools. Tools are the backbone of every business and every productive person's life. So what is one tool, software, or whatever tool that you like to use? What is one tool that you could not live without?
Oh, boy. You know what? I don't really want to say that I have a tool that I cannot live without other than maybe your cell phone. And I think that the one thing that people always discount is the ability to communicate. And I don't care. Like we use PropStream, we use all sorts of programs to do the sending out texts and all that stuff, but nothing that couldn't be replaced. But the one thing that you can't replace is having the ability to communicate at your hip and being able to communicate at any time and text and all that stuff and communicate with your team. So if there was one tool, and I think, again, people discount it, it's just getting on the phone and talking to folks. So I would just say a cell phone.
I couldn't agree more. Me and my buddies were actually sitting around drinking some beer and just thinking about like, how did people do business before the internet? We just don't get it. How do you do it? It's amazing.
It was brutal. I did fax and phone call, and you moved millions of dollars of merchandise around the world. It's
just with numbers and just doing that rotary phone over and over.
Sucks. Yeah. If you ever hear a fax machine, like there's somebody was listening to what we know as the fax machine, they're like, what's that? And I'm like, what? It's a fax
machine. Is history, my friend. That is history. All right. And that leads us to the very last question. This is for the listeners. You've given us a lot of good advice, a lot of good stories. I'm sure people want to reach out and say hi. What is the best way for them to do that?
Well, I would say just Google my name, Toby Mathis, and you'll see my YouTube channel. My face is all over the place. Just subscribe to the YouTube channel. And all it is just you're looking for things that might pique your curiosity. And I'm constantly putting out new content 2-3 times a week on different subjects. And you never know when one's going to be relevant to you or pique your interest or be something that you could benefit from. But that's what I would say. You could always contact our firm and say, I want to consult and things like that. But let's fill that brain first and let's figure out kind of who you are and what you're doing. And once you get there, then you can use professionals effectively. Otherwise, the professional will use you, and you don't want that.
Absolutely. All right. That is Toby Mathis. Go ahead and Google that on YouTube. I'll also put the link to Anderson Advisors in the show notes. So if y'all want to reach out to Toby, I'll also put the YouTube channel there too. So just click a little more in the description. It'll pull down the description, and in there you can find Toby's URLs.
Awesome.
Toby, that wraps it up. Thank you very much for hopping on the show.
Always fun, Gabe.
Absolutely. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.